Hi, Trent here from My Risk Advisor. We've got another episode today. Today I'm joined with Phil Thompson.
Hey mates, how you going?
Very well. We're going to be talking breaking news.
Pew, pew, pew! Breaking news!
2 weeks late breaking news by the time this actually gets released.
What happened?
We're going to be talking about the sale of Clearview to Zurich.
This is, I tell you what, an insurance industry is slow moving, boring, not much happens, but we finally get some exciting news. I feel like an investment analyst. They get things changing all day, every day. Finally, insurance, we get some breaking news. So
yeah, there's no trade deadline in the insurance industry, but this one feels like a deadline day deal a little bit. There's actually a little bit of movement, a little bit something I didn't probably really expect. Didn't expect Zurich to buy it originally.
Yeah.
If I was to be speculating, it probably weren't the purchaser, but here we are.
Here we are. We're here today. So what happened?
So the deal is Clearview have sold to Zurich, of course. The deal is worth $415 million.
Big bickies.
Big bickies.
And they sold around $300 and something million worth of in-force premiums as well. So a decent amount of in-force premiums. You know, the other competitors in that space. So there aren't many insurance companies that are listed on the ASX. The one good thing about being listed on the ASX is you can see their P&Ls, you can see their revenue from insurance. And so, yeah, I think I should have this number in front of me, but I don't. I think it was around $330 million of in-force. And another kind of competitor in that space is like a Noble Oak, and they're half that size when it comes to in-force premium. So decent sized business.
Yeah, decent sized business. So for history lesson of Clearview, if people don't know about Clearview, where have they been? What do they do? They're not one of the bigger insurers, but they have been around for a little while now.
Yeah, so let's take a bit of a history lesson. Back in 2010, Clearview launched, and they took over NRMA's life insurance business. So took over the license and set up a new insurance company in 2010. Over that time, they moved into the advice space. So it was licensing advisors. They then got into funds management space, and then since exited those businesses. So I think they finalised the exit of their funds management business back in 2024. And so they fully got out of that. They fully got out of their licensing business. So then they became a pure life insurance business, primed, ready to sell and lower the complexity.
I remember that email coming out when they sold their funds management. It was Clearview was sold, and I was like, what? Clearview sold? And then dug a little bit deeper past the headline, and it was just their funds management. As most people would have expected, ready to sell, and they've been for sale probably ever since then, but finally found that buyer, which is great for them.
Yeah, and that's the other thing. It's been the worst kept secret is that Clearview's always been ready to sell. Yes, so that's my understanding. They've been on sale for a little while, but congratulations to Nadine and the leadership team for executing the sale. And like all things, we've been through this before. If anyone's been around the advice space for a little while, we've seen movements in the industry and purchases and sales of insurance companies. So it's always interesting to see what will happen with the people. And I've spoken to our BDM. I gave him a call and touch base. No one knows anything yet. It's going to take a little while to go through ACCC and get approval to finalise the exit of it.
Do we have a rough date at this stage, or is it just
open-ended? I don't think they know. Because when you're listed, you've got to. There's so many rules, so they've got to announce it that they've gone into this agreement, and so they can't go and get approval from ACCC before they kind of enter this agreement. So now the next step is to get all the regulators who need to give their stamp of approval before they can actually execute the change. But based on kind of history of other kind of similar moves, it's probably 12 months, 18 months maybe before it finalises everything.
So the marriage celebrant has asked for objections at this point, and no one's probably going to put up their hand, but Shrek might run down the aisle and object at some point.
You in true Trent style, you're bringing obscure references that only 2% of the audience will understand. So yeah, exactly that. We're waiting for the objections on the marriage.
Perfect.
Yeah.
I can't see them coming anytime soon.
No.
What does it mean for current clients with Clearview if they would be watching the news, if it was on the news that is, or reading any finance articles and see that Clearview's for sale? My policies with Clearview, what happens?
Yeah, we have 900 odd clients with Clearview. I looked at the numbers after the sale. I don't believe we've gotten any emails from any clients asking what's going on. So it didn't make Channel 7 headlines or didn't make any TikTok reels, I guess, for our clients. So no one's actually asked what's going on. But the policies stay the same. That's the great thing about the space that we work in is Zurich can't come in and make any changes to the policy other than premiums. So they can make those changes, but they should just transfer across. And the purpose of this conversation is just to absolutely speculate with zero information. But for any advisors out there listening who haven't gone through this process or experienced this, it's good kind of a reminder just to understand kind of what has happened in the past and what's going forward. But essentially, all the policies will be exactly the same. All the terms and conditions, whatever the client signed up on, they get that at claim time.
Perfect. Before we jump into speculating on what we think might happen, let's talk a little bit about the history of sales of other insurance companies and what happened after those. That will give us a bit of a guiding on what may have happened, but then we can talk about what Zurich have done as well.
As you said, we've done a bit of research. I mean, it didn't take very long. We've been around long enough to see this, but there's actually quite a few transactions. Like we're talking, 8, 9 transactions across within the insurance industry. So yeah, it's exciting. It doesn't move very often, but we actually have seen quite a bit in the last 10 years, I would say. I think maybe 10, 12 years, these transactions. So the first one, we've got AMP sold to Resolution Life. What did they do?
They closed the product. Resolution Life weren't even selling business in Australia, new business. So they just closed the product and held onto it, drove the premiums through the roof. And now we've shipped it off to our Ascender at this point. So Ascender's currently looking at buying that one.
Yeah, so they've on-sold it, which is a little bit unique in this space. I'm just looking at our notes. This is a unique one. So AMP Australia sold to Resolution Life, and then Resolution Life globally sold their global business to Nippon. So those two mega companies acquired each other, and they needed to get about, we think that Clearview to Zurich gets a lot of regulatory scrutiny. Imagine being a global insurer in many, many markets. Because Resolution Life, they were on sale in New Zealand, so they were selling that product. Now they're going to all going to go to Nippon Life. So this is a bit more interesting, that transaction, because it needed regulatory approval from, basically half of the regulatory bodies around the world. So now that's going to be merged with Ascender. Well, MLC and Resolution Life have merged, and the beast is called Ascender now.
Whatever Ascender means. I'm sure I've been told at some point what it meant, what the slogan is. But
yeah, I have no idea. But I mean, actually, before that, we can even talk about MLC. So even that business got sold from NAB, National Australia Bank, over to Nippon Life as well. So that's why that MLC brand is getting retired as well. Yeah,
they kept the brand for 5 or 6 years or something around that, and just recently they've lost the rights to have that brand, and Ascender is their new slogan, a new brand name.
Yeah, so we're not even going to go into too much detail about that MLC acquisition, but effectively it was a similar kind of business that moved across. Next one was we got BT. They sold to Tower. What happened there? Yeah,
BT sold to Tower. They closed the product as well. Probably not as aggressive on the premium increases, but you have seen them over the time of drastically increasing. I know your policy went up a fair bit.
Yeah, we had quite a few policies at the time before. Tower didn't need to do the policy increases because BT did that for them. Well, just before the sale, actually from memory, and I'm pulling this out of the memory bank, so feel free to let me know if I'm wrong, but my memory serves me right. They went into that agreement. BT then went and did repricing and smashed everyone. The highest I remember was agreed value level premiums went up 72%. 1 year, and then the next renewal went up 18%, the next renewal, and that was before it actually moved over to Tower. So BT or Westpac already did that, did the dirty work for them, so it didn't have to go under the Tower brand, those repricing. But Tower came in and said, we will still call it BT, and then a few years later they rebranded all policies to Tower. So now I've got a Tower policy.
Oh, fabulous. And it's all amalgamated in their system and should be easier to do increases and that sort of stuff if you need to.
Yeah, exactly.
We've got Astron next. What happened to Astron?
So Astron was owned by Suncorp, and then they sold to Tower. This is, I'm going to go back and say 2018, maybe even earlier, 2017, 2016.
It was the first 2 years that I started, so it's about 6 years ago. I remember that one.
Yeah. So that was much smaller business than BT, but they transitioned from being owned by a bank to being owned by Tower, and that was the transition that they did. They already had those. I guess the reason they did the BT transaction was they already had that experience getting a bank-owned insurance company into Tau. So that was that Astron sale, and then all of those products are no longer, they're all Tau branded.
Yep. So the next two we've got on the list were both AIA. So we'll talk about CommInsure first. What happened there?
Yeah, so CommInsure, owned by Commonwealth Bank, just like every other bank that we've talking about, got out of the insurance business. So they sold to AIA. And as part of that acquisition, AIA had a 20-year distribution agreement with Commonwealth Bank to send referrals to AIA as a part of that transaction. So they acquired all those policies. They also acquired the advice business as well. So AIA took on that advice business as well. So I had a meeting with two ex-CBA bank advisors. One got out during that transaction and one moved over to AIA Wellbeing. And so, that was a part of that transaction. So the whole insurance book moved across to AIA.
And the other AIA one we had was Integrity, which was pretty recent.
Yeah, very recent. It's and sold is a generous term. It's
quiet at the death.
Yeah. It was beggingly taken on. And so AIA, Integrity, no one really wanted that business. It was a very small business in terms of total in-force. Retail book was maybe 20 million, I'm going to say. Again, that could be very well wrong. Assume everything I'm saying is wrong if you're listening to this, but it was a really small book of clients. But the regulator said, hey, Integrity, we're talking about, we're going to run out of money in a few years' time. We're literally not going to be able to pay out these claims. Regulator stepped in and said, we've got to sort this out, and kind of just did a deal where that all got transferred over to AIA. And then AIA just instantly did a repricing, which makes sense. They weren't forced to do anything, but it was kind of a, hey, can you please do us a favour by taking on this book? And they immediately repriced it. Some of our clients, we reviewed our full client book because we had, do you know how many clients?
120 odd, I think we had.
Yeah, we had a decent number of clients with them. We did a full review. What were the prices? What is AIA's new price? And what does the market look like? And a big portion of those clients we actually kept with AIA because they weren't out of market. And some of the premiums didn't go up significantly. Some did jump quite a bit. But that was very unique in the scenario where AIA said, we will take it on, but we will fully reprice immediately. We don't want to take on anything we don't really want to.
Yep. Yeah, that's the list of sales we have outside of Zurich. There's probably a few out there that we have missed and probably a few before our time. But for the Zurich ones, so Zurich have actually done it a little bit differently from what we've got written down. We've got two recent sales, and obviously the Clearview one now. We had Macquarie as the first one. This one happened before I was around.
Another bank getting out of insurance. They do not like the insurance business, those banks. So Macquarie sold to Zurich. That was fairly straightforward. I don't remember. I wasn't doing much insurance back then, so I wasn't so keyed into what was going on. But just like everything, the product state remains the same. One thing that they did do is they maintained a particular product that Macquarie had, which was Macquarie Active. Now it's Zurich Active. So they've even though the book is brought into Zurich, they have allowed that on-sale unique product to still be on sale, and Zurich still sell it today. And we use it for our clients. And so, you can maybe talk about where we use it, because it's not it's different. It is unique. So when do we use it for our clients?
Yeah, we use it for specific cases, pretty much when occupation doesn't allow permanent disablement. But the BDMs will tell you to use it all the time, because of course they will. But they believe it's better than your standard life trauma and TPD. It's a bit of a mix and has looks at different body organs, and different levels of illnesses get you different levels of payments. Far harder to understand than what it is if you become permanently disabled. You're paid out. You suffer a major illness, you pay out. It's spin the wheel. Let's see where you land on this level. All right, you're in the middle. This is a 30% payment of this.
Yeah.
So we use it when we can't get TPD that is based off occupation, because it does have occupational stuff within that. It's far better than your non-working TPD, and has a few different things in there for that. Yeah,
and the good thing about the pros of an active product is that if it's a trauma or a TB, it's a yes or no. It's everything or nothing. With the exception of partials and whatever. But with the active product, it's like, well, we'll dial it up. As it becomes more severe, well, you get that next hurdle payment. And so theoretically that makes sense because you don't, TPD, the design flaw, which all insurers are complaining about the design flaw as well, is it's everything or nothing, and it's so binary in terms of that, what you do and what you don't get. And the hurdle to get it can be really difficult. And so, the active product makes sense. And it was something unique. Zurich didn't have that product and they weren't going to design that product. So they may as well they've got to keep the in-force book in place. So they may as well allow it to be on sale. I don't know what level of business they get from it. I can't imagine it's a lot. There will be advisors out there in the market who sell pretty much exclusively because they believe in it. They've had clients claim on it when they otherwise wouldn't on other things. So, but yeah, as I said, we happily consider it in our business.
Yeah, so that's the first one they took on. The second one was OnePath.
Yeah, so another bank. Another sale. So OnePath was owned by ANZ. ANZ got out of the insurance business and that got sold to Zurich as well. I'm trying to work out if the ANZ advisors went over to Zurich. I know the AIA Wellbeing took a lot of the CommBank advisors, but I'm not 100% sure about the Zurich Assure business. I think actually that got set up later. But again, assume everything I'm saying is wrong. If you are Zurich or OnePath, from that business,
give me a history lesson.
Yeah, feel free to give me a history lesson and give me a better understanding. But from an insurance point of view, this was more unique as well because they kept the two brands. They still have the two brands and they still have them separate, and they talk about as a differentiation of products. And so if they've got two on sale products, then maybe we get better inflows. The other thing is, it's interesting about this, every other acquisition, I'm trying to think, pretty much every other acquisition was sold. A bigger insurance company acquired a smaller one. OnePath and Zurich was a smaller business than OnePath that they acquired. So
in Australia.
Yeah, in Australia. So in terms of what they acquired like a significantly bigger business. And that could also be the reason to keep the naming of OnePath. So, if you've got, 20% of your business or your policies now are Zurich and got sold Zurich, do we want to move them all to Zurich when 80% know OnePath? So that's probably another reason. OnePath do have an interesting product offering that's a little bit different, is the living expense cover. It's kind of like a baby income protection, if you will, for people who aren't working. And so that could be a reason why they've kept it open as well. But again, I can't imagine that's getting too many sales.
No, we would have less than half a dozen policies on there, I reckon, over the time.
Yeah, it's not a big one for us. And to be honest, we've got the opportunity to talk about it, but we don't use it very often. But yeah, so they've got two brands in Zurich too, and it's kind of confusing.
Yeah, kind of confusing. Run on the same platform, not the same quoting software as of yet, but as with all insurers, they'll promise the world that you can quote on one, and 50 years later, when I'm retiring, they'll probably deliver.
It's one of these things that I've never seen an insurance company go through a software transition and it not blown up their business. To be fair, Zurich has actually always done pretty well on their software and the tech stack. They've always been kind of front in terms of what they've delivered and always been really good. So I guess not wanting to push it all in together, don't break your Zurich quoting software just to bring in the OnePath. I guess that's maybe why they've moved slowly with the integration there. But now, next Zurich acquisition, and the one we are talking about today, Clearview. So what do you think is going to happen here?
Well, there's a couple of things at play. We've seen the history of Zurich that they haven't closed products when there's differentiations. And there's also the other products that are out there that are doing different things in the market. So we'll talk about that first. There's NEOS has their platform with 3 separate insurers on there looking to become the one-stop shop to quote with 3 insurers and do due diligence that way if that's where you go as an advisor.
If you're an advisor out in the market writing a decent level of business and NEOS haven't approached you and asked you to write 100% of your policies on the NEOS platform, then your BDM's not working hard enough, because that's all I've heard from NEOS in the last 12 months is, when are we going to get Sky writing all of their business on our platform? So that's their business. They're the platform business, NEOS are.
Yeah. So does that leave Zurich in that same position of going, well, if we keep Clearview alive, we have 3 different options with 3 or 4 different offerings with the active, Clearview's with the accident-only covers, which they're the only ones in the market that have the disablements, income protection and TPD for that accident-only. Does that leave them as a direct competitor to go, well, we actually own these insurance companies. We've got all the different products for you. Come and do one-stop shop with us, and we'll get it all done for you.
Yeah. Yeah, it's interesting. Yeah, when you mentioned this the other day when we heard the news, you were like, I wonder if they're just going to try and compete on that platform play, compete with the NEOS, because Zurich haven't partnered with NEOS on their NEOS platform. They do have a partnership. They do work together on selling Medibank private life insurance policies, where Zurich's the underlying insurer, NEOS is the administrator of that, and Medibank is the distributor, if you will. So they've got a working relationship. Wouldn't have a clue if it's good, bad, or otherwise. But Zurich haven't, from my understanding, what I understand, then they're not on the NEOS platform or have plans to. So that could change in the future. So yeah, having that platform play being different is really interesting, whether they keep the Clearview brand alive just so they can say, well, we've got Zurich, OnePath and Clearview, so you can write it all across us, and we can keep the reinsurers separate, because that's what NEOS talk about. They've got 2 insurers on their platform but 3 reinsurers. So or do they just roll it in, call it all Zurich, bring everything together, call it all Zurich, but have a really good product set.
Products.
Yeah,
so
they got
have
the
all
active,
the products, but all their
accident only.
Yeah, Zurich accident only, Zurich active, and then your OnePath rolls into your Zurich, and you keep your living expense cover.
Yeah, at the very least, my hope is they keep the accident only. That's a product that I know. I mean, we do quite a bit of accident only when it's needed. So I'd love them to keep that open at the very least, because the difficulty with advisors is having big product differentiations. If every insurer had like something super unique and super different, that's hard to compete. But having one that has some sweet spots, has the size and the scale to be able to continue to offer those sweet spots. I'd love Zurich to keep going, okay, we're going to keep that active product open. We don't get huge market share, but if it fits a need, and we'll keep the accident only, we'll keep the living expense cover. They can really start to have pretty meaningful scale to compete against like the Towers of the world, who are, Tower are very vanilla. Like they're the big behemoth, but they're very vanilla in terms of their product offering, which is good.
Yeah, and if you've got all the different products under your one roof and you are an advisor looking for that one-stop shop, it's pretty hard to look away from if this all happens. What Zurich's doing, because you can get that accident-only cover, you don't have to go, all right, I normally go with what NEOS is doing. Damn it, I need to do active accident-only cover today. I've got to go across the road and do it over there and get all the logins and that sort of stuff. It just simplifies that for that one-stop shop advisor.
The other question, and the kind of last question I have about the whole thing, is what do we think about the insurance market? Do we think it's a net benefit to have less insurers, or do we want more insurers in the market? What are your thoughts?
I like probably where we're at the moment.
Post Zurich
closing, we've probably got room.
Clearview closing,
sorry. Probably got room for 1 or 2 more maximum, I think. Realistically, when you're looking at market share, making sure that these insurance companies are profitable and we're not getting integrities that come into the market and then are exiting in 2 or 3 years' time. We definitely don't want it to drop to 2 or 3, because there is so much difference in underwriting across the different reinsurers and insurers. So if we're getting down to less, we're getting less and less options. Everyone's shopping at those same places. If we're getting declined somewhere else and we should be able to get it somewhere else, it's not going to happen. So I think where we're at, that 7, 8, 9 insurers, is probably where we're at with the size Australia is.
The conversations I have with people, and I'm trying to think of, it's always interesting. You've always got to check the conversations you have. If you're an advisor out there, always check the opinions of people and what company do they work for. Like if you talk to anyone from Tower, they'll be like, oh, I think we probably need 3, maximum 4 insurers in the market. Well, okay, because you're definitely going to be one of them. Yep. That's why that's your opinion. And so you always got to check the opinions. But I do know people who I know and respect, they do talk about actually does need to be consolidation in the market, and it's not bad for the market to have some consolidation. So we've got a good relationship with Clearview, and I'm glad that they've finally have an outcome that we know where they're going to go. They're owned by a significant player in the market, so we can feel really comfortable that those policyholders are going to be looked after. And then some of those smaller insurers where PPS, they've got a very particular niche, and just stay profitable within your niche and continue to slowly grow. Don't try and get super aggressive to try and be massive. And the next smallest, trying to think of the insurers in the market, is probably MetLife is the next smallest now. Now MetLife is got a lot of good things in terms of they got a massive group book, and so that really keeps them afloat. But Clearview, they only had a retail business. They lived and died by advisors recommending them. I think if there's one or two more consolidations, I wouldn't, I'd be okay with that as long as the big players are doing their job and doing their job well. I think Ascender coming back once they sort themselves out with the Resolution Life and, all of that gets all sorted out, I think they can come back really strong. And, historically, or over the last 5 years, have kind of dropped the ball, but they are coming back really well now. So, I want, 3 or 4 big ones and then a few kind of niche players is where I see the market being and where I think it'd be really strong.
Yeah, and the one thing we haven't talked about is that reinsurer market, making sure that there's reinsurers that want to play in the Australian market. There was probably a little bit of noise earlier this year that reinsurers were less comfortable with Australian insurers because of TPD changes, IP changes, larger pressure on claims. So
Swiss Re basically said, hey, we're not doing new business for any they paused new business. At the end of last year, they said, we're pausing all TPD sales. And everyone who was or every advisor who knew that their insurers were reinsured by Swiss Re went, hold on, what? Does it mean we can't set up a new TPD policy? And they're like, no, it's fine. We still can, but they're not negotiating for new contracts, for new policies because of concerns around TPD. So Swiss Re kind of pulling out of the market is like, okay, what's going to happen here? Do we need more reinsurers in the market to bolster kind of the marketplace? And I think I'm a big fan of the acquisition. I think it's a great move. I think Clearview being acquired by the big behemoth that is Zurich is a great thing. I don't think anyone's any advisor who's doing volume is really sad that there is there is consolidation.
Thanks, Phil, and thanks for listening out there. And we'll see you on the next episode. Did you say you've got a clear view on life?